Afternoon all, everyone. My name's George Hay. I'm Associate Editor of Reuters Breaking Views. The title of this panel is Policy and Regulation for Scaling Finance for Impact, and we've got a great panel of people to talk about it. First of all, we've got Sacha Sadan, who's the ESG Director of the Financial Conduct Authority, previously of Elgin. We've got Catherine Howarth, CEO of ShareAction and scourge of companies with rubbish net zero targets. We've got Jonathan Labrey, Chief Policy Officer of the Value Reporting Foundation, which seems to be part of the ISSB, which is obviously pretty fundamental for this topic. And then we've got Clara, Barby, who's a senior partner of the Just Climate Fund, which is part of Generation Investment Management. So, Clara, I'm going to start with you, if you don't mind. When we talk about impact investing, you do get still a lot of asset owners who look a bit askance at it and think, this isn't about financial returns, I'm going to panic. So how do we kind of reassure these people, and how do we kind of bring them on side? And do you see that happening enough?
Oh, enough. I'm not sure it's happening enough, but do I see it happening? Yes. So I think the first thing to say, and I think this is really important, is that there is a spectrum of capital that we need to have an impact, and there is absolutely a role for concessionary strategies. And I don't think we should see that as, money that is undisciplined. You can have incredibly disciplined concessionary strategies that are pricing exactly right with the appropriate level of subsidy to achieve a particular type of impact. So there's a role for that, but that is not the whole spectrum. And I think your question is getting at, is there also a strategy that's appropriate for institutional capital, institutional mandates widely, where they can make sense of it in the context of fiduciary duty? And I'm going to let Catherine comment more specifically on fiduciary duty. But I would say one of the things that we've learned, and Just Climate is focused on what we're calling it climate-led investing. And I'll explain what I mean by that. But the reason why we call it climate-led is we've learned that it's not helpful to get into a debate about impact first or finance first. Right. And actually that characterization was perhaps useful at a point in time a decade ago. But at this point in time, the way that we've been explaining it, and I can talk about how it resonates with asset owners, is to say, for institutional capital markets, you can lead from a thematic research perspective with identifying solutions, in the case of climate, which is our focus, that are going to make the biggest difference. So when we take that research approach, we end up, it's the same approach that a policymaker or a scientist would take, you end up with the highest emitting, hard to abate sectors. So in our case, we're focused on steel, cement, HGV trucking, aviation, long duration storage. And we want solutions that will completely decarbonize those industries as much as you can. In some cases, you can't do it all the way. And I mention that because if your research process starts with that, you are applying an impact lens. But in that context, we then underwrite investments as you would commercially. We're looking for the solutions that are great opportunities for our clients. And I think that narrative is helpful. The idea of an opportunity set and characterizing an opportunity set is something that's familiar to asset owners. And in fact, in the case of climate, they see that it's not only a moral imperative, it's an economic opportunity too. I think just the final comment I would make is that it's okay, I think, for the motivations from institutional asset owners to vary a bit. So we find in some cases, depending on the time horizon of the investor, so a pension fund with very long-term liabilities, this is a question of economics over time, and it makes sense in a portfolio context. It's about system-level stewardship. That's one motivation we hear. Another will look at it from the perspective of opportunities and wanting to be part of solutions that are going to be the heavyweights of a green economy, which is where they think policy is headed. It's okay for that variation, I think, at this point in time.
Right. Well, Catherine, you were mentioned there. On this point of fiduciary duty, are there any occasions when organisations should perhaps prioritise or reprioritise profit to benefit impact?
Well, yes, and I think within the kind of opportunity set for investors, happily, there are quite a lot of opportunities where achieving a tremendously good financial return sits alongside opportunities, for example, in renewable energy or whatever, where there's also, as it happens, happily, a tremendous opportunity to achieve positive environmental and or social impact. But that's, if you like, there's a bit of a Venn diagram that it doesn't capture all of the opportunity set out there. And so I think it's our perspective on this at ShareAction is that the reality is there is market failure at work. So there are many, many investments that pension funds and other institutional investors are invested in, which generate quite significant negative impacts on the environment, on society, on individuals. And often at the moment, it's quite well financially rewarded to exploit
especially
the planet and people. And so that's the kind of tricky area. What do you do about that? And one of the really interesting things is when you ask actual pension savers about their preferences in this area, people have very strong preferences. Not everybody, and that obviously needs to be a really good balance, and you do need to achieve great pension outcomes for people. But the appetite for amongst ordinary people with pension savings to be more ambitious on impact and more avoiding of investments which create negative impacts on people and planet is higher than their fiduciary investors who make decisions on their behalf. And so, although there has been tremendous reform, very helpful, and I really want to hold up the DWP, the Department of Work and Pensions, which has introduced a number of regulations helping to clarify that, for example, it's absolutely incumbent and appropriate and, in fact, obligatory for investors to manage environmental and social risks when they're financially material. But we think they should actually be able to go a little bit further and acknowledge that many of the investments they hold do have negative impacts that actually come back and affect the lives of their beneficiaries. And so it ought to be the case that in the 21st century, the regulations and the law around pension investing allow trustees the freedom to take decisions which are always guided by the best interests and the best outcomes for their beneficiaries. And sometimes that might mean going a bit further than they can today in the law to privilege and put impact out considerations, higher up than they're really allowed to in the law today. And that would be, I think that's one of the ways we would unlock more finance for impact. That was the question for the panel in a way, was how do we unlock more finance for impact? And I think one of the inhibitors and the barriers today is the current fiduciary regime for pension funds, which does hold them back from doing things which their own beneficiaries seem to have a real appetite for doing, which is never going to be and mustn't be about throwing prudence out of the window financially, but it should be the case that you can take a really long-term view. You can, for example, really encourage companies to act as good employers, to avoid modern slavery, even in cases where, in the short term, to do so might be more profitable. So that's the kind of crux and the dilemma. And I think, I'm very encouraged by the fact that there seems to be more and more, whether it's pension lawyers or trustees or asset managers, that acknowledge that we're sort of bumping up against the outer edges of what the law will permit, and there should be further reforms, I'd suggest, that help unlock more finance for impact and really help pension fund investing to meet the needs of today's and tomorrow's generation of pension savers.
Are we anywhere near that happening?
Yeah, well, we've had a generation of pension fund fiduciary reform over the last few years, and I think the current pensions minister has been really bold on it, and I'm very encouraged that just 2 days ago, Friday, he announced a new task force looking at social factors in investing. He's done brilliant things on the climate side, and he's recognised that we need to do more on the S side. So I see appetite, and I see more and more players in industry, as well as the general investing public and pension savers, saying, what can we do next? Can we go further? So I think it's going to happen, but only if the kind of players that are in the room today do begin to kind of marshal this debate and bring real solutions forward to the policymakers and the supervisors, because they can't do it alone.
Yeah. Jonathan, I mean, one of the things that is incredibly important is just the measurement of impact and that's something you know a lot about. What's your take on how the global framework is progressing for that objective, do you think?
Yeah, thanks. Well, I come at this conversation very much from the disclosure and corporate reporting perspective, and over the last 10 years I've been involved in developing and promoting the adoption of something called the Integrated Reporting Framework, which takes the idea that there are six resources and relationships that businesses use every day in order to create value over time. And a couple of those capitals are social and relationship capital and human capital, but they combine with financial capital and the other resources that create that value over time. And we've developed a framework that has been globally applicable, so it's a voluntary framework that is now adopted in around 70 countries around the world. The great advantage of developing a global principles-based framework is that you can get speed of adoption, because there'll always be frontier companies that want to adopt something that's new, something that's innovative. The downside is that you don't get necessarily the scale of adoption with a voluntary framework. And so the real game changer now is the establishment of the International Sustainability Standards Board under the governance of the IFRS Foundation, which gives the opportunity for a global baseline of disclosures on sustainability matters that will be complemented by jurisdiction-level requirements. So, we can never have one organization that is responsible for all the disclosure standards for the whole world, because different jurisdictions will have public policy requirements that they wish to respond to, quite rightly. But what we can do is develop a global baseline that will help with the comparability of information and get there to be some kind of standardized level of information, but it building on all the decades of experience that has been developed from the voluntary frameworks and standards that have been developed over the last 10 or 20 years. So the real opportunity now with the ISSB is developing that global baseline of disclosures on sustainability information.
Right, and Sacha, I mean, you're a regulator.
I am.
Lucky you. What's the role for kind of actual laws, harder laws rather than just kind of principles in this? Obviously we can see what the Americans are doing. The SEC has some plans. We have our own regime, the Europeans do. How do you think that fits into what we're talking about?
Well, it's a big question, but the first thing is, it's not just about laws. So when we talked about TCFD in the past, it started voluntary, but then the FCA was one of the first people to make it mandatory and to bring that forward. That will be the same with ISSB. So one of my colleagues, because I'm here, is in Frankfurt today, helping the ISSB on how they're setting it up and making sure it's international. So it's not just in one region or another, because the most important thing is we get one metric on supply chain, one metric on diversity, one metric on some of these things, so that then we can think about product impact, and then we're using the same language. So that's one role the FCA has to play. But then some of the rules that you might mention are labelling. People are coming up with some fantastic products out there, but the industry and the consumer is quite confused, because lots of people have said very nice things about their products, but there aren't many KPIs. Or they're saying they're green, so the phrase greenwashing, as you know, but there's also social washing, as Chris Hayward mentioned. So I think it's quite important that we then bring in a labelling standard very soon and make sure that if it's not fit for purpose, we will stop people. Not because we want to stop finance, we want the credibility and the trust to be there so that people can feel confident. And as Catherine has said, people do want to invest this way. One of the other things that we're doing, because you've mentioned this before, but a lot of pension schemes have been going, I can't buy those things because they're not daily pricing. So we've come up with the long-term asset fund, the LTAF. Regulators they love acronyms, so I'm going to have to learn this, LTAF. And that is allowing monthly pricing. You can put some of your assets into a long-term DC scheme that can be in impact products that can't be priced daily. And why should they be if it's a 20-year time frame? So we're allowing the market, and then of course it's up to the providers to come up with that. So instead of private equity owning things, we're hoping pensioners in an end pension product can own some of these impact products.
Right, interesting. Question for all of you, maybe I'll start with Clara. It's just, the S of the ESG, which is pretty important to how and the measurement of it is pretty important to what we're talking about here. How do you do it?
Can I controversially?
I don't know. How do you do it?
That is also a long conversation, but I think there's two things I'd love to highlight that have become very important in our practice. The first one is I'm going to change S to people for the sake of making this point. It is about people. It's about people. It's not as catchy, but it is about people. And I think it's a mistake to believe that business and finance doesn't already look at people in their decisions to a certain extent. So I think this idea that S is a sort of bolt-on is false. Every single asset affects people positively and negatively, and in some aspects of business and finance, we're very good at understanding that. Marketing, to understand consumer preference, that is about understanding people and how they live their lives and what they need and want. And so I would like to think that the S conversation becomes around expanding from a very narrow focus on certain people in certain ways to a much broader understanding of how every business model affects a whole range of different people. And moving from short-termist to long-termist, which is what Catherine was getting at. And I think if we did that, that's changing how we think about people, but it's not introducing something new. The second point, which I think is probably the most important to me as I look at a lot of the narratives around ESG and I look at a lot of the practice, is to remember that we talk a lot about metrics, and Sacha, you commented on metrics. We do need measures. A lot of the time they can be quantitative, sometimes they'll be qualitative, but we do need measures. But a performance on a metric is impossible to understand unless you have a threshold to compare it to. And we're not talking about that enough. If we just have a lot of information about performance on metrics, but we don't have social and ecological thresholds to say, well, is that performance good enough? What are we aiming for? Is it sustainable? It is meaningless information. And so I think one of the things I'm hopeful about is, can the industry get to a point where we're having meaningful conversations around performance on a metric related to people relative to thresholds that establish what good enough is. If you look at the trajectory of wages and you look at how we moved from minimum wage, there are some countries that, Myanmar, for example, only got minimum wage recently. So this is very nascent still in some geographies. But in a sophisticated economy like the UK on people, we've had minimum wage, we moved to living wage, we moved to real living wage. That's just one example, but it gives us a threshold for what good enough is. And if we want to use the term sustainable investing, we have to start talking about compared to what is sustainable.
Right, but Sacha, I mean, from a perspective of kind of data, on this, like, what is the FCA doing to compile data? Can you give me any examples of how this would actually evolve?
Well, there's two areas. 2 weeks ago, we put out our feedback statement on ESG ratings. And it was nearly universal that the industry agreed with our proposal that we should regulate ESG ratings to try and get much more commonality, because they're very important, they're being used a lot, but there's also so much confusion, and we've seen that debate where certain oil and gas stocks are in a rating and certain stocks like Tesla are out. I'm not saying one's right or wrong, but the methodologies are being confused.
Like
he's not happy with that, no. But I think it's really important then we do that. Conflicts of interest, management of them, and disclosure for ESG ratings. So that's one area. Another area is diversity and inclusion, including socioeconomic. We're going to start pushing companies to give us the data so that then people can start using that
What's
data.
it like at the moment?
It's pretty patchy at the moment. It's voluntary. Listed companies are pretty good, but most companies are not very good at showing that data. Of course, there's a reason for that, because if they don't think it's that good, they don't want to show it. But the reason is no one is good.
Can you kind of tell the companies that really suck because they
You can normally tell, and I think what's important is then we use that as part of our regulatory process. But socioeconomic data or ethnicity, we want that data for everyone to look at and see how we can, and then we have some metrics hopefully and some impact funds to try and improve that. So there are two areas that we're looking at, ratings and D&I data.
Right, interesting. Jonathan, what do you think about this particular issue, the S, like the measurement of it? How do you think the ISSB is going to approach it?
Well, from the ISSB's perspective, their due process means that it will be very much for the global stakeholders to determine what the agenda will be for the ISSB. So at the moment, you'll be aware that they're consulting on their climate standard and a general requirements disclosure standard. And then there'll be an agenda consultation to ask stakeholders what they would like the ISSB to prioritize in the future. And I know that this is one of the issues that potentially could be one of the next agenda topics for the ISSB, but it will be very much for the market to write in and determine that. I think from looking at the practice of integrated reporting and how social capital, for example, has been communicated through integrated reports, the lesson that we've learned is that it's really important not to approach this from a silo-based approach within an organization. So have the interrelationship, the connectivity between thinking about social capital and the other resources and relationships, financial capital, human capital, and so on. So not treating these issues in a silo. I know I've heard talk about the potential for another framework being developed, and I start twitching slightly when I hear about new frameworks, because we're trying to, at the moment, get out of this alphabet soup of different frameworks and standards and try to get to a situation where we have consolidation and combine all the incredible work and innovation of the last 10 or 20 years and try and consolidate that. So I think that people should perhaps start with what has gone before and assess whether that can be used before starting to develop new frameworks. And I say that for one very important reason, which is that what we've been trying to do over the last few years is elevate reporting and consideration of social capital, human capital, and all of these issues away from compliance within companies towards communication about the governance of the organization, and get boards of companies, get the management of company properly engaged in these questions about the allocation of resources, the allocation of resources that impact the strategy and the business model of the organization. And if you create, too many very detailed processes and frameworks, and that will often get delegated into the realm of compliance when we want these issues to be elevated to the realm of corporate governance. And I think if I had one message for regulators drawing on experience over the last few years, it's first of all take a leaf out of the book of the UK FRC and allow innovation. So they've created the lab, the reporting lab, that is enabling the regulator to come together with investors and other stakeholders and businesses so that businesses can start to develop and innovate in a safe way on some of the reporting requirements. And then secondly, really look again at corporate governance codes and see whether some of these issues can be reflected more in corporate governance codes, again, to encourage the boards and top management of companies to engage in these issues.
I was just going to add one other point. There's enough things out there. So a perfect example, and I'm not going to mention, it's not E, but net zero. Everyone has made a net zero claims. So we don't need any more claims now, and that's what we're working the Net Zero Transition Plan task force, which I'm on. And what we want is to make sure it's linked with just transition. So if you're going to put out a commitment to net zero by 2050, although some people are saying net zero by 2030, you have to read the asterisk sometimes on that one. But if you're going to make a commitment, what we want is what are you doing, who's accountable, all the things, and then how is that linked to the just transition, and have you thought about it? So we are trying to tie them together rather than come out with another framework, and that's a perfect example where we will then mandate that you can't say net zero unless you've got a plan, and that plan fits or comply or explain with a template that is going to be consistent, hopefully internationally.
Well, and actually, Sacha, that is also a perfect example of having a threshold, not just a metric. Measuring GHG emissions is meaningless unless you have net zero and science-based targets that allow you to understand whether you're on the right path. And I think that, so it's a great example of the point I was making. And I think, I feel strongly about this because I think we're going to see in the S what we're seeing in the E, which is a deeper conversation around transition and investing in transition and understanding when it makes sense to do that because you're on a path to good.
Yep.
And I think we're going to have the same conversations in the S.
Catherine, do you want to add something on the S before we talk about
I just wanted to, I think it's important, really important to acknowledge just how far behind the S of ESG is compared to the E. It is just constantly, and has been for so many years. I don't know why. I think, well, one of the reasons why I think is that CDP, a fantastic pioneering organisation, we're very fortunate at ShareAction to be chaired by the founding, the founder of CDP, kind of came up with a real fantastic method to kind of take out to the corporate community for reporting on climate. And there just hasn't been an equivalent. We have been developing at ShareAction something called the Workforce Disclosure Initiative, which is an attempt, like 20 years on, to bring the same level of rigor, investor-backed, it's completely modeled really on CDP, but, and it's growing really nicely, but you know, it's really interesting that everyone is on the climate and environmental bandwagon, thank goodness, because we have a climate emergency. And it's been driven by regulation. That is what is really upping the pace, which is amazing. But I would argue that we're entering a bit of a social emergency right now. You know, I think the cost of living crisis is really meaningful, and I don't think the investment community collectively has really understood the implications yet. So we have a climate emergency, but we also have a social emergency, and we do not have the infrastructure yet inside the global investment community to handle and track it. We don't have, I mean, I would argue that something like the living wage is to the S what net zero is to the E of ESG, but you know, it's not widely, you know, we don't have whatever 13 trillion of assets under management pledging on living wage. We do have it on net zero. So there's a long, long way to go. But it is pioneers like the people in this room that will move the dial. And I think ISSB is a hugely important opportunity because we don't want to bake in that inequality between the E and the S.
Just to bust in,
go on.
Do you think it's, I mean, part of the problem here is that the E is less, I mean, that the S is more kind of geographically specific perhaps or culturally specific than the E, or not?
Well, I think a living wage is a living wage. Now, of course, the level of it will be, you know, based on basket goods. There are different costs of living in different countries, but the concept of adequacy, you know, we all have the same number of hours in a week. And we all have, you know, albeit slightly different, based on, in some economies and countries, there's more, you know, we're very fortunate to have an NHS, so we don't need to build cost of healthcare into the living wage calculation in the UK. You would need to in other jurisdictions. So, of course, there's some differential, but the fundamental concept is quite broadly applicable, I think. And I'm very, you know, I think really well designed, not just to help people meet their needs, but actually ultimately to build the kind of sustainable economy that can thrive and be really financially successful.
I've spent my life talking to chair of Remcos or people like that who would say their employees are their most important asset, and then you go, well, can you prove it? And you would remember the old house builders that were getting paid £84 million but didn't pay the living wage, which would have cost 15 million.
Yeah.
These are the debates that need to get much higher up the agenda, and I think they will do with the cost of living crisis. And it isn't just about pay, it was about share option schemes and things like that. It was like, well, only people who can afford it can put money away for 5 years. What about the lower paid employees? So there are data points already there, but they're not always used, and I think that's where we need the consistency.
Where's the pressure going to come for this to happen, though? Because I mean, it's
well, it's started to happen already, as you can see from the debates that are happening on the living wage. I think good companies are already starting to do that. I saw Unilever announce that it's going to go globally, the living wage globally by 2030. Right. That will put pressure on other companies, and I think the S is starting to have its time. I think the S is definitely going to get its time now.
Right.
And I think it comes back to the, I always quote this speech that Mark Carney gave which kicked off the whole TCFD process, when he talked about the tragedy of the horizon and us knowing about these risks, but all our disclosure horizons, all of our corporate governance is based on, you know, looking backwards and looking maybe a year into the future if we're lucky. Whereas I think if we extend our horizons a little bit and think more long term, then and take into account these future risks, social risks as well as climate risks, and I think we will actually make a huge stride towards this. So we almost need a kind of TCFD moment or a tragedy of the horizon moment for social issues. For
social stuff.
Yeah.
But I also think, Jonathan, you're doing yourself a disservice, because one of the roles the ISSB is going to play, I think, from a disclosure as one of the levers, is that, you know, I don't know whether it'll make it to the final standard, but certainly the current exposure draft that's out requires disclosure of targets and whether they're science-based. And it's for the S, it's in the general requirement, it's not just for the E. And the minute companies have to disclose their targets, they're going to start saying, well, what should they be? Who do I turn to? What does this look like? And I hope it's just one role disclosure will play to help. It will stir up a conversation.
And link it to their pay.
And link it to their strategy and their pay.
Well, I just wanted to express the view that I think the UK can be, is already and can be an incredibly key global leader on this ESG question. And it's why this event is so important, and the Lord Mayor's leadership and the City of London. And I'm really proud. I mean, I do think on the climate agenda, the Pensions Minister has genuinely been really world leading, and it's just excellent to see him following that up with this new focus, this new task force on social factors and the S of ESG. So I think post-Brexit, part of what Britain's vision for our global financial sector and our kind of leadership in global finance has to be embracing all of this and really innovating in this space, but showing real commitment. And it can't just be about voluntary standards, much as I think we really do need voluntary standards because they tend to be where the leadership and the innovation emerges. But it's got to be backed up by policy and regs. And I'm very encouraged. Just the very fact that Sacha has this job, Director ESG.
Yeah.
Hey, yay. Good sign.
Yay.
I'm glad Sacha has a job. That's good. Cool. Well, just Catherine, just on this point about investor stewardship, you are investor stewardship guru. Just from, do you think there needs to be regulation in it? Do you think it's fine as it is, or do you think there needs to be more of a stick or something?
Yeah, do you know, I hate to be the person that says yes to that question, but I think if we think about, let's just take the climate transition for a minute, where everyone is agreed that, you know, that stewardship of companies is completely critical to getting to net zero, because we don't want an approach to reaching net zero which just involves investors that have made a net zero pledge dumping everything high carbon out of their portfolio, selling it off, and then, you know, achieving net zero that way. That will not decarbonize the real economy. Yeah. So stewardship is the answer to that to a very large extent. It means sticking for the long term with companies and helping them invest in the transition technologies they need to really move their industries, their sectors and their business models to net zero. Well, if we think that stewardship is such a critical part of achieving the net zero journey, and by the way, I do think the same is also true for the S of ESG, then it worries me that stewardship is part of a voluntary code of practice run by the Financial Reporting Council, which is a fantastic regulator. We really interact with them. I think they get a lot of things right, particularly around stewardship, but they don't have the teeth that the FCA has got. You know, they can't really sanction senior directors and key personnel in regulated investment firms in the way that the FCA has. So I do see a real role for moving stewardship code onto a mandatory basis, and that needs to be, I think, it's part of the logic of the UK's vision for being a net zero financial centre, and it absolutely needs to also encompass the S of ESG.
What would it look like, though? Like the regulation, what would it do? How would it work?
Well, I think a lot of it is there sitting in the stewardship code. I think so it's just about moving that not onto a basis which isn't just pick and choose. Yes, we fancy doing this thing called stewardship. You know, at the moment for pension funds in the UK, my view, sorry, shouldn't have touched the microphone. I used to be a pension fund trustee, and I think that in order to really invest for the best interest of your beneficiaries, stewardship is just a critical part of the toolkit. But how many pension funds in the UK are stewardship code signatories? Quite few. So now it's more of the big asset managers are, thank goodness, and there's some brilliant stewardship behaviour in our asset management industry. But, you know, it is all a bit pick and choose at the moment, and I just don't think that is good enough, given the importance of stewardship in achieving our public policy objectives.
Well, I spent 11 years doing investment stewardship, so, and I joined the FCA because let's start with practical. I don't want to wait for years for something to move, and I don't think always we need to do that. We are already working much more closely with the FRC, and we want to make sure that when we supervise banks, insurance, asset managers, that their credentials are put to the test so that the information that is given is still used across the park. So I think we're already doing a lot more of that. And it is becoming quite a battleground, isn't it? People are trying to use stewardship as a way of being much more commercial. And therefore, I think those claims are going to be much more put to the test. And when I speak to many asset manager CEOs, they know that they need to make sure that they're backing them up more, because there are starting to be quite a lot of greenwashing circumstances out there. And no one wants that, because it doesn't help the industry, apart from anything else, because it will stop the credibility of this industry. It is getting better, though, and I think we will work much closer with them in the short term.
Catherine, you mentioned divestment there, and I mean, do you think divestment are just getting rid of polluting stuff and giving it to someone else and claiming that you're kind of fine and not really helping the planet? Do you think that's kind of on its way out? Do you think engagement and stewardship, the kind of thing you're talking about, is becoming more widespread?
No, I think actually I'm quite concerned that at the moment all the pledges that have been made on net zero are becoming a big fat incentive to just do quick and easy divestment.
Yeah.
So I think if anything, it's obviously brilliant, and thank goodness that Mark Carney played this incredibly galvanizing and impressive role securing commitments from global financial institutions in the lead up to COP that were announced. But now everyone's sitting scratching their heads thinking, well, how do we get there? And the easy answer to that is you dump high carbon stocks from your portfolio into somebody else's, and that's not decarbonising the real economy. So I think that we've got some quite problematic incentives built in at the minute.
Well, Clara, this is kind of your area, isn't it, really? What's your perspective?
Well, so I agree entirely with what Catherine said. I am really encouraged, actually, that in most of the transition conversations we have now, even in the letter of documents, we say transition of the real economy, not transition of the portfolio. So I think that conceptual distinction is starting to be more widely understood. But I agree with you about the perverse incentive. I think the interesting thing is I'm interested in what a portfolio looks like. How could an investor actually get to net zero if they only dumped the really carbon-intensive stocks? I'm not sure they could get there. I think it's a really interesting, the reality is if they're genuinely committed to net zero, they have to address transition of existing assets. And so I just think we need to speed up the journey that everyone's on, but we really need to speed it up, because right now I feel people are committed, but thinking that they might deal with it, next year after, and we're running out of time.
But how do you deal with that problem? I mean, as you say, the incentive is for everyone to be holier than thou and kind of divest as quickly as possible. And
so the practice that the firm I'm part of more broadly does is stewardship. You use engagement, deep engagement with companies. But in order to do that, you do have to this goes back to the long-term viewpoint. You have to know, what does sustainable look like? What are the thresholds associated with that? Where are we going? And where is an asset today? And how can I help move it? You have to do the hard work on that.
But just one really kind of interesting idea, I think, is to do portfolio attribution analysis year on year on year. So you look at the decarbonisation journey a portfolio has gone on, and you say, was that achieved through moving the portfolio around or through the decarbonisation of the underlying entities? That's actually a very achievable way of tracking. And I think if investors had to disclose, power of disclosure, an attribution analysis around their decarbonisation, I think that would potentially put a bit of discipline back into this in a really helpful way.
Yeah, I think this is such an important point, though, and let's use it for the S. If we'd spent on diversity, gender diversity to start with, go to ethnicity, if 11, 12 years ago when we came up with our big push, when there was 11% women on boards, if we'd have just said, let's just buy the companies that have got women on boards, we wouldn't have got anywhere. We're now at 39%, and we pushed and we worked hard, and it was stewardship, and it was a lot of things. Same with ethnicity. I think we're now at 98% of the FTSE 100 has ethnicity, whereas it wasn't many before. We have to stay in the tent, you have to engage, you have to push, and you have to explain that. Because doctors don't just treat healthy people, and we're not going to solve this if we just start thinking about this, about just owning things. So our labelling, one of the things that we're going to do in September, is absolutely fine to own something for a consumer to go, it does own an oil and gas stock, it's okay. But here's what I'm doing to make that oil and gas stock part of the future.
Thing, right, isn't it?
Has to be clear, has to be explained. And by the way, there is a bit of a backlash here at the moment. People are saying, I hear it, so I'm sure you hear it as well. But you're making companies go private, or that people are going to, the reason that there's a cost of living crisis is red tape or whatever. We have to make sure it's part of the solution rather than just divest. And some of the rules that we've had from Europe have been more about taking stocks out rather than influencing the stocks that are in. So it's very, very crucial.
Right. Just, I mean, on the where do you think, Jonathan, the banks are on this, and the financial institutions? Do you think they are, I mean, obviously, as Catherine mentioned, there was, or alluded to, the GFANZ initiative at COP26, and they managed to, with a bit of huffing and puffing, they managed to get all the banks into the tent. Do you think they are happy being in the tent, or do you think they want to be out of the tent, or?
Well, we're hearing anecdotal. I mean, this is quite anecdotal at the moment, but that a lot of banks globally are starting to put a lot of pressure on businesses, particularly with term loans when they're renewing their term loans, and they're putting new requirements on the banks, so on the companies that they're lending to. So we're hearing that quite anecdotally. But there was one issue that I did want to just raise, which is more of a macro concern that, I mean, we're reading a lot about at the moment in a high inflation environment globally, which is we seem to be seeing investment in innovation pulling back slightly because investment in future assets, companies that aren't making a profit, for example, but will do in the future, as people kind of go to the safety of high dividend assets and maybe the oil companies and the traditional companies. And I just wondered whether, again, just from a policy perspective, there was a role here for government to have a conversation with people about this, because it seems to me that there's a bit of regression going on just generally, particularly if the high inflation environment will last for longer than a year, if it becomes sticky, then are we going to get the level of investment in the innovation that we need in order to power the transition that we're all talking about? So that is just a concern that I think affects everybody, but I think probably is more at a government level, needs to be addressed.
Sacha, can we address that problem?
We can. I mean, I'll give you a specific example on banks to start with on the S. Bank branch closures. Again, each individual bank is making a profit decision, but is that the right thing for the community? And that's something that the FCA is working really hard now to try and come up with a plan of access to cash in those regions. So again, it's all really good and I understand it, but we have to make sure, so we're convening the banks to make sure that they can do that, and hoping some pilots are coming out there, which is a solution that can have one branch bank that could have all of the different brands inside that to work. So there's a proper example of S. But if you just done it from a profit perspective, it was the rational thing to do. Some of them say only 7 people turned up in the branch last week. It wasn't economically sensible, but we must have banking for everyone. That's just a practical example. The other one is green mortgages. Green mortgages are fantastic and we're very pleased and we want them to grow and we want everything else. But we don't want it just to be for people who can afford to put solar panels or loft insulation in and they get a lower interest rate. Yeah. So we're trying to work out at the moment, literally some ways of financing so that other people who can't afford it straight away get access to that and get a lower mortgage rate, because then it gives the incentive and that would help reduce demand, which is exactly what we need to do as well as the supply debate in energy.
Right. Catherine, do you have any other thoughts on the bank situation and how well they're doing or not doing?
Well, we just, it's a topic we have worked really closely on for a number of years, and we are going to publish in December a new up-to-date assessment ranking of Europe's 25 largest banks. And we have historically looked at climate and biodiversity performance, and for the first time we're going to look at how banks are thinking about and really hardwiring social considerations into their financing decisions. So that's going to be fascinating and I'm excited. And my own view is that banks, first of all, they have a critical role to play in the transition and in the social development of all of our communities, and that at least on the climate transition, there's some really, really good movement underway in the banking sector. I don't think they get all of it right, and ShareAction obviously is can be quite a challenger. But I really think it's an example of where stewardship has really made a difference, a real positive difference. Because, and by the way, when companies hear from their banks that their access to capital and financing will be contingent on their environmental and social performance, it really focuses minds. It's so powerful. So I'm actually very optimistic about that. But I think ultimately banks are commercial entities that do need to make a profit. So we need to have a level playing field created by policy and regulation that unleashes and unlocks the positive power of the banking sector to drive, the social and environmental outcomes we need.
Right. Anybody else want to?
No, although the whole conversation that we've been having has made me think about where responsibilities lie. And Catherine, you were calling on there are some things that are the role of government. And I know that earlier today there was discussion around just transition because of the important launch of that effort, and that we're a part of that. I think I just want to sort of flag that I think there's a conversation we all need to have about just transition, which we're not having right now enough anyway to help practitioners, which is when I think about transition, you've got transition out and transition in from a financing perspective. So you've got where you're using shareholder activism to drive, existing fossil fuel plant closure, for example. That's transition out. But you also have, much like the work I do, investing in solutions that are transitioning in. It's new jobs. I think we need to talk about whether just transition requires those who are financing solutions for transitioning in to create new jobs. What is their responsibility in terms of the displacement effect of that on other parts of the economy, which are going to lose in that situation where they're successful? Because we don't hold, in sort of sustainability and ESG more broadly, we don't hold investors to account for the negative effects of market disruption that's caused by better healthcare products or better educational products. Are we doing the same with climate? And I think that's just I don't have the answer for you now. I think it's a conversation we all need to start having.
Okay, well, I think we're going to leave it there because we're at rush for time, but you stay tuned because there's a case study that focuses on place-based impact investing in the UK coming up next, which may or may not have something to do with the banks example you were talking about. But I'd just like to say thanks to all our panelists. Really interesting discussion. Thanks for your time.